one of the guys that I hired to do acquisitions with me, his hobby is sports analytics. So he made a NCAA bracket optimization model where he can predict and improve your odds of winning your bracket by 4 times. He figures out what stats in basketball are correlated with winning and how the teams match up. And so we did the same thing for the multifamily markets for appreciation. So we got every possible stat we could get our hands on, from population by zip code to supply, demand in every market, population growth, job growth, really everything that you could get from CoStar or Yardi, either by market or by zip code. And then what he did was he figured out what was correlated with appreciation and what was not.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 396. My guest today bought his first 4 rental properties at the age of 19 using savings from his high school internet business. Today, Drew Breneman is the founder and CEO of Breneman Capital, where he focuses on undervalued multifamily assets and has built a portfolio of $200 million in assets under management. Drew harnesses the power of data analytics to drive his investment decisions, gaining valuable insight into the market trends, property performance, and tenant behavior. Drew, welcome to the show.
Thanks for having me, Brian. Happy to be here.
Tell us a little bit about yourself and how you got started investing in real estate.
So I started, like as you mentioned, in high school. I had this side hustle basically where I was selling items in these online video games. So a couple of my buddies, they were playing this game called Diablo 2. So this would be back in like 2002 or 3, probably 2002, I think. And so they're playing on the computer. They sell their items in the game, like what their character had accumulated, for real money on eBay. And, I hadn't played the game, but I heard, hey, you're making money doing this. Let me check it out. And playing the game to then sell your items wasn't a good way to make money because it would take hours and hours to get these items. But what I did see was sometimes the same thing would sell for $5 and sometimes for $20. So I saw that and said, hey, why don't I just buy this thing when it goes for $5 and then put it up with a buy it now or an auction and sell it for $20. And I did that. And then I just rinse and repeat. I kept doing it. I did thousands of transactions over the course of 4 years where I wrote down every one in a notebook for the delivery, then crossed it off. And I recently moved from Chicago to Austin, Texas, and kind of was going through some stuff and I found 2 of the notebooks. And it's literally a full notebook, whatever they are, 70 pages, 2-sided. Every line is filled out in these notebooks and crossed out. Like it looks crazy in retrospect to see all the deliveries, but it was just, I like doing it. I really didn't have another way of, I didn't have a job at the time. It would have been like a sophomore in high school when I started it. So I kept all the money in terms of how I got into real estate. And since I didn't go and buy a car or do anything with the money, really, I just saved it all. So my parents, they were both teachers. So we didn't have like a business family per se, but they had, especially my dad, he had talked a lot about investing in mutual funds and other things. So it was something I had heard about and was interested in. Then when I got this money from the internet business, I want to try investing in the stock market. So I did. And then, I didn't really like how that was just completely out of your control. And then 2, I was, I'm a teenager. So then if it doesn't go up in the first week or month, I'm start reading books on like what else is there out there to make money, because the stock market thing's not working for me. And so I read Investing in Real Estate by Gary Eldred. And that was like the light bulb moment for me, where he was explaining the ways you make money in real estate. It's all the stuff that you and your listeners would already know. But when he talked about appreciation, the light bulb really went off for me, where his example, very simplified, was you put 10% down on let's say a duplex. And if it goes up 3% a year, that will be a 30% return on your equity. I heard that and I got really interested, because that was, not even factoring in cash flow or paying the loan down. Obviously you do this more, and like usually you need to put more than 10% down, and things just don't go up 3%, every year like he's talking about. But it got the light bulb kind of, lit in my head. And then when I went to college, so I'm from Wisconsin and I was going to go to UW-Madison, and I did. I thought, all right, I'm going to buy a rental property my freshman year and move into it my sophomore year. So I did that. I bought a duplex, 614 South Brook Street for $220,000, put 15% down in it. I was able to get, not that I needed to, but I had income from the internet business, and because this was 2004 or 5. So, I could have probably done a no money down loan, but I did a normal loan, put a down payment down, and then was off and going in real estate.
I want to skip ahead because one of the things that you've figured out how to do is leverage data to build your multifamily portfolio. And you currently have $200 million in assets under management. Tell us about that and how you've been leveraging data in your business.
Just like you said, so Diane, to skip ahead, now we focus on multifamily deals in the Sun Belt, 5 to 50 million. And we syndicate the equity to, high net worth individuals or family offices. And so I have been living in Chicago for the last 10 years, and I just moved to Austin, Texas, just kind of set the stage what we were doing. But I had only invested in the Midwest, and I'd see, we did really good deals where our average return on the deals we did was a 25% IRR, but it was not easy. Like we would, spend all year and buy 2 or 3 deals, and I'd see these folks, in other markets, and it would seem like you could buy almost anything in these places with all the tailwinds and hit that kind of return. So I set out, this was in 2021. One of the guys that I hired to do acquisitions with me, his hobby is sports analytics. So he made a NCAA bracket optimization model where he can predict and improve your odds of winning your bracket by 4 times. He figures out what stats in basketball are correlated with winning and how the teams match up. And so we did the same thing for the multifamily markets for appreciation. So we got every possible stat we could get our hands on, from population by zip code to supply, demand in every market, population growth, job growth, really everything that you could get from CoStar or Yardi, either by market or by zip code. And then what he did was he figured out what was correlated with appreciation and what was not. So interestingly, when you look at all like multifamily, supply is actually not correlated with prices almost at all. It's a very low correlation. And so just into a correlation, not something that folks have heard about, like let's say a 1.0 correlation, someone would say that's a strong correlation, or that would be like an exact match, where if you have a high correlation, the two things will move exactly the same. If you have a low correlation, they don't move together at all. So then that was a surprising insight. But when you think about it, it makes sense where, let's say you have a building where it's 20 years old and the rents are $1,500, and then across on let's say a 2-bed, because this is literally the exact situation, a deal we have in Phoenix. And across the street there's a new one they just built, and they charge $2,650 for 2 beds. And people say there's a lot of supply in Phoenix, but then I kind of when you actually are doing it, like that doesn't really hit our building. I feel like because it's such a big spread. Obviously, if prices fall so much, I mean, conceivably, a couple people might want to pay up. But so when I heard that, I started to think about, well, that actually makes sense. The top correlated things were the highest correlation to appreciation. It was population growth, as a percentage, and then also job growth as a percentage. So one thing I hear a lot of people talk about, and I've actually heard my dad do this, and I kind of almost find it funny, where he'll say how many people are moving to Austin, Texas, for example, but in like raw numbers. So he'll say whatever it is, 200 a day. I don't know how many it is, because it's kind of a funny stat, because like you don't know how many are moving out. You don't know how many are already there. So that also made sense to me, where it's as a percentage. So if you hear like which city has the most U-Haul moves, it's like, well, okay, of course it's going to be the big ones, Phoenix and Dallas and Miami, where all the people already are. So we use that to pick our new markets. So I had only bought so far in my career up to that point in Wisconsin, Minnesota, and Illinois. So those are very stable markets. And so that was a huge plus, and there's a lot of cash flow there. But now as we enter these growth markets, there's more volatility in terms of the rents going up and down and the prices. So that was another thing that we looked at.
Let's backtrack a little bit here, because your friend has kind of an analysis where he's looking at population data, job growth. and some other metrics to determine where are you going to find the greatest appreciation? Is that the goal, is to figure out what areas have the greatest appreciation?
Correct. And how we measured it was in relation to the national average, and the output in this model is how many standard deviations above or below it will be with the national average.
Is this a predictive model that's looking to the future, or is it looking to the past and saying, well, you had this appreciation in Austin or wherever, and we'll assume it's going to continue? I mean, how does it know that an area hasn't already reached its prime?
What he did, Evan, who works at Breneman Capital, he went back, and then so we pulled all this data, and then we have appreciation by market that we pulled from CoStar and Yardi. He had to calculate it, but you can get sale prices for the same property and then go back and backtrack what the price was if you want to create your own index, or you can download it from some of those sources. So we had a couple different price indexes, and then he would look at, okay, the prices moved like this in this market, and then he would be able to test individual variables on how they were correlated with the prices going up or not. So then what he did was he figured out what the correlation was for each variable, and then he would apply that to the future projections we would get. So you can't go out too far where our projections and then of course is, back testing it. So then really it's a good insights for the current year. And then you kind of gut check that if you're me against what is the model saying. And it's, the top markets in our model the last few years, it's Phoenix and Tampa and ones that don't surprise you. So you look at that and say, this all checks out, kind of emotionally. And then we're pulling in what predictions we have for population growth and new supply, like for apartment deliveries and demand, like that stuff's all like available. Those projects started, and then you can predict from there because what's correlated, what's not, and you have the stats for the next 1, 2, or 3 years. It doesn't go up beyond that. And then he can test the R-squared value, which is some sort of test on the accuracy of the results that I don't truthfully fully understand, but the R-squared value is very high, especially in those first 2 years.
You were coming from the Midwest markets, Chicago, Wisconsin. What did the data tell you about those markets that made you say, hey, what were some of the surprises that you learned from those markets by looking at the data?
A couple surprises where we started looking at the price volatility in markets. So like kind of the next exercise, also looking at how markets were correlated. So let's say Phoenix and Tampa, for example, they moved together like very similarly. And then we also, and then looked at the volatility in prices over time in different markets. And so I guess a lot of the strongest insights I had were on those sort of things when you looked at that and also going back and looking at the index, let's say in the 2008 to 2010 time. Like one thing that we found was was very highly correlated as well. Like I think the third most correlated thing with multifamily values was single family home values. So a lot of people say, like right now interest rates are up, so then people will not be as likely to buy, so they'll drive up rents, and then that doesn't actually seem to happen, or at least not to the extent that it would drive up prices. So that was one insight.
The thinking is, logic would say, if people can't buy a house, they're going to rent, and it's going to drive up rents, and that's the logic. But you're saying the data doesn't support that, or at least the data that you were looking at didn't quite support that.
It did not. We went back, and this was kind of like a separate calculation within sort of this exercise. But yeah, there is a 0.72 correlation between rent growth and single family home appreciation. And this is from 1962 to 2021 when we did it. And so you would think they wouldn't be that related. It would almost like they'd move at different times. Like, oh, rents are spiking because, homes got so expensive, then homes flatten out because everyone's renting and moving in, driving up the prices. Another thing that was interesting, because to what we just were talking about, where interest rates go up, so then that's going to make more renters, if you will, and that's going to drive up rents. There was a 0.30 correlation between rent growth and the change in cost of borrowing, and so like that also kind of debunked that thought. And we've seen that the last we'll call it year, where interest rates went up, but rents didn't explode. They actually leveled off, and it seemed like what happened is I don't have data for this, but it seemed like new household formation basically stopped, or at least whatever the net would be, is there were enough people doubling up being worried about a recession or high interest rates or inflation or whatever it was, people that were renting one bedrooms, maybe, because of COVID or spreading out or something, then they go to two bedrooms or back to their parents' basement to save money. Cause it doesn't seem like the actual of demand side hasn't done so well the last year. It certainly seemed like with rents, falling in a lot of places are not going up very much.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Let's talk about the prevailing thought is, and it's interesting because your data is pointing to a different conclusion, but the prevailing thought is that it's kind of location specific. In areas where you've had a lot of overbuilding, a lot of new construction and new pipeline coming online and being absorbed, there is an oversupply. So you're going to see the rents stabilizing or coming down. And what I'm understanding is we are seeing that across the country in places. I'm in Grand Rapids, Michigan, so I'm a Midwest market where we haven't had that overbuilding. We don't have that new supply coming online, at least not to any degree that's really going to oversaturate the market. So rents have not started dropping here. They've either kind of stayed consistent, but they're definitely, from what I'm seeing in my portfolio, still rising, just not at the rate they were a couple of years ago. Or last year, actually.
Grand Rapids in our model, it was one of the best markets in the Midwest, where I think Indianapolis, Grand Rapids, and Madison, Wisconsin were the top three. All three are predicted to be at the national average or above for appreciation, and those markets trade at higher than average cap rates. So if you consider that as well, those are all really attractive markets.
Talk about Grand Rapids, and what were the other two markets you mentioned?
Indianapolis and Madison.
The metrics you looked at, just describe that a little bit, go into a little bit more detail if you don't mind.
And, and Evan made the model, so he could tell you literally everything that he made, how he combined it, what he did it. And he likes Grand Rapids as a market for sure. And really where, anything that's scored above the national average, it's going to have strong population growth, strong job growth. And I would say that's going to be that's really what I bet's driving at, where that's a really good, economy it's under the radar. And so when you factor that in with where cap rates are, I know they probably feel low to you now compared to what they were a couple of years ago, because it gets more attention and it hasn't had really like a tail off in performance of the properties to push up cap rates a lot. So I would usually, that was the case, like even if there was a lot of, let's say, near-term supply, that really only impacts the properties that are, directly competing with it. So if there was, say, a lot of supply, that's only going to compete with the new Class A stuff. So even if a lot of supply was coming online in Grand Rapids, that's not going to, push the model too much one way or the other, because we're looking at the whole market. So that's including all the Class B, Class C stuff as well. So, but yeah, I think that's, that's a good under the radar spot for sure. And so you're fortunate to be there.
You chose to move to Austin. What did you see there? What did you see in the Austin market or the Texas market? You've talked about Phoenix. What are you seeing there that's making you say, hey, this is still a great place to invest in?
So in our model, the number one, or not in our model, looking at in the data, the number one market for job growth as a percentage and population growth as a percentage over the last 5 years is Austin, and not by a small amount, by over 2 standard deviations above the national average. And there's not another market that comes close to touching it. The next closest is Raleigh, but that is even still quite a bit behind Austin. And then those two markets are just Raleigh and Austin. For those two stats are head and shoulders above the whole country, but especially Austin. And I had an advantage, so to speak, where my sister and brother-in-law already lived here. So then they already know the market too. So it's good. They're not in real estate, but they've lived here for 5 or 6 years. So then out of the markets we've now focused on, which is Phoenix, Dallas, and Austin. And now we're really in each market sort of for, I'd say, different reasons where they don't perform the same, where, Phoenix has had crazy rent growth. It has the best property taxes in the entire country in terms of how it works. There's a 5% per year assessed value cap that doesn't in your taxes don't change because of a sale. So you have really high rent growth, and you have essentially capped taxes at 5% increases per year. Insurance is extremely low there because you don't really have like any natural disasters. There's no tornadoes or hurricanes or floods or anything. So even though it's really hot there, and it doesn't hit your insurance numbers. And then Dallas, we like Dallas because it's sort of similar. It's in the Sun Belt. It's the largest city in the Sun Belt. So it's like the next kind of, I feel like it's the gateway market of the Sun Belt. So these institutional investors, these big shops, they want to be in New York and LA and San Francisco. Those places are losing their appeal somewhat. But it's also interesting in our data, those were the best markets until 2008. And then let's say when we had the data, I think it was going back to in the 90s. So in the 90s to 2008, those top markets were a reason. It was for a reason they traded at the lowest cap rates and had the most institutional demand. But after this whole Sunbelt trend, I know it feels like it was just started with COVID, but it actually has been going on since 2010, coming out of the GFC. And so Dallas I like a lot because just it's very stable. And so that had some of the lowest price volatility, where I was talking about that metric I liked, where some of these other Sunbelt markets did not. Phoenix, Vegas, everywhere in Florida, prices have been, they can be up and down. Whereas in the GFC, home prices in Austin and Dallas, they only went down about 10%. Whereas in Florida, for example, they went down over 50.
What are some of the markets that you would warn everyone to just stay away from based on the data you've looked at?
It would be welcome to have Evan on too, because he can go like next level, where I'm basically giving you the summary. He could give you how it was made and this deeper insights too. So maybe if people like this, like we can get Evan in on this. But yeah, I think one of the what I was surprised by was California, where the prices are high there. So kind of how I always thought was it must go up the most, like the fastest appreciation, and it isn't. I don't know when prices got so high, because since 2008, like I was saying, it's lagged the national average in basically every market in California, except the Inland Empire has done well. There's such a tailwind from shipping and the Port of Long Beach, Port of LA being there, and all the industrial. That was a big surprise to me, as well as the most volatile market in the entire country for prices going up and down. Like you would think it would be Florida, Phoenix, Vegas, those have a lot of volatility, but actually it was the Bay Area. So that was very surprising to me. But then you look at it and you're like, yeah, in 2000, 2001, everything's color coded in this model. It's like the brightest red for the biggest drop, most volatility. And then, similar in the GFC times, 2008, 2009, 10, where prices got so high then, where it's expensive. And then, I don't know what it is, if it's just like in the culture where it's expensive. And if I don't need to be here, then I'm leaving. If that's the local attitude, I have no idea why. But those were the two biggest surprises I had, where I kind of thought of the Bay Area as this stable, growing area, such a strong tech base. That's like the whole engine of our economy, in my opinion. At this point, it seems like it's tech, and it was the most up and down.
Top 5 markets you would recommend in no particular order.
And I hate to not give like a straight answer, but I think it really depends where you live. Because I would say I can give you the top 5, but then if you live far away, it's harder to invest there. So the top markets are all in the Sun Belt. But it's interesting, like hearing where you're in Grand Rapids. I would say you should just focus only in Grand Rapids. You know every street at this point, and you can invest really well there. You can self-manage the properties if you want, or go to them so easily. A deal comes up for sale, you can go right to it. So I don't know. It depends if you're starting out or what you're trying to do. And so for us, we're trying to build a significant company where I have, acquisition staff and people, we do asset management where I used to do every piece of it, but now we're building a real company here. So the top markets the other thing is what I'll say is it depends what you're looking for, where if you just want straight appreciation, the best ones are Phoenix, Austin, Dallas, Tampa, and Orlando. Those were the top 5. But if I wouldn't say just invest in those 5 altogether, because Tampa and Phoenix move very similarly, and then the only markets that have a lot of stability in that pool is Austin and Dallas. So it just depends where you are. So I would say, but it was not a surprise. The best markets were the Carolinas, so Raleigh, Charlotte, and then Nashville, pretty much anywhere in Florida, and then Dallas and Austin in Texas. Houston and San Antonio were below average, and then Phoenix. Those were the top ones. But again, there's a lot of unique scenarios where, if you're in Grand Rapids or, Indianapolis or Madison, you can get above average appreciation without having to travel. So I know that's not 5, that's just jumping around. One other insight on the markets real quick was Salt Lake City and Denver didn't do as well as I thought. Those are known as really strong growth markets. And one metric we didn't talk about that was important is the affordability, so what the rents were. And then also actually what was correlated with rent and price growth was just how high the rents were just in raw dollars. So just Denver and Salt Lake are expensive. And so those were, I think, great markets the last 15 years but now it's expensive there and you're having slower growth as a result. It doesn't mean those are bad markets, but you're paying, let's say, a similar cap rate to what you would be buying in Charlotte or Raleigh or Florida or Texas for Salt Lake and Denver. And those are, poised to perform not as well. So that was an insight for me, because I actually thought those were going to be some of the top markets when we started this.
So Drew, as we wrap it up here, what is your favorite hack or app?
So like I had said, I just moved to Austin, Texas. We need to sign up for, if you wanted a TV and internet. And I'm not a big TV guy. I'm actually the worst person. If you're like, hey, did you see this show or movie? Odds are I haven't. But YouTube TV, that app, you can watch TV on your phone. It's so easy to use. Obviously, you can connect it to your, any Wi-Fi enabled TV. But that I just literally did that. And when you're like, what app? I'm like, I wish I would have known about this before, because I like, if you're like me, I never sit in front of the TV and watch TV. The best I would be able to do for like watching TV would be, I'm going to do something on the computer, but I do like the NBA playoffs. So then I put it on my phone, or I need to get a screen in here or something. But that I was surprised by, and it's actually the easiest way to watch TV. You just can tap on the screen like it's a YouTube video and bump it ahead or behind. So that's how I'll be consuming my TV going forward.
Tell our listeners how they can find out more about you or get a hold of you.
Going to Breneman.com. So B as in boy, RENEMAN would be the best place. So you can sign up to be a passive investor in our deals right on our website. If you want to just invest in real estate but not do any of the work, and you can sign up there. We also have some downloads. One of the things that we had talked about in this conversation here, we have a PDF. It's a download. It breaks down interest rates and rents being correlated with what we were talking about. We shot a podcast on my podcast and then have a PDF download with it. We did that last summer, but that's on the download section. We also have a passive investing guidebook for passive investors that want to learn all these terms and how things work. If someone says like, oh, this is the cap rate or unlevered yield on cost, or this is a core plus deal, like all those, it's 100 pages. We got everything in there how you could find. So that's all on the website too, under the downloads. So I'd say that would be the best place to go. I also have a podcast. It's called the Breneman Blueprint. And then that's a real estate investing podcast. And you can just get that on YouTube or anywhere that you get your podcast. So
Drew, thanks so much for coming on the show and sharing your data insights. It was a pleasure talking about the different markets, especially Grand Rapids, and the ones you're investing in, and then the ones you're not investing in. Really interesting insights. So thank you so much for sharing them with us today. It's been a pleasure.
Thanks, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.